Hey everybody, it's time for the end of the second quarter, end of the quarter review for the S&P 500, and also known as the C Fund, or the index that the C Fund follows. Those of you who are new to the group or the site, whatever, um, this is basically I take a look at what goes on with the earnings across the entire S&P 500, and also how the index and the C fund both performed. Actually, not so much talk about the C fund performance itself, but the S&P 500 performance, because the C fund basically mirrors what the S&P 500 does. All right, so I'm gonna give you an idea here what we're going to talk about. As usual, we're going to cover the index-wide performance results first, and then we'll get into the sector by sector actual performance versus what I was expecting before the quarter started. And then moving on, we'll get the index price target and valuation levels. These are mainly for, there's a combination of targets there for both the buy and hold crowd and the swing trading crowd. And I'll explain those when we get to that. And next would be index forward earnings growth projections. Basically, what to expect over the next year from the S&P 500 as far as earnings are concerned. Basically, and what I mean by this is that earnings. If we know what's going on with earnings, we know what to expect from price performance too. Doesn't mean the price is going to actually perform in the same manner, but generally fundamentally speaking, the prices always follow earnings. That's the key driver of price behavior. So if we know what's going on with earnings, we know what to expect, what should be reasonable and what isn't reasonable for prices as well. All right, so then after that, we'll move to historical S&P 500 price and earnings performance. Basically, give an idea how the earnings side has performed over the last whatever period of time, and then what the index itself has actually done in price performance. After that, we'll talk about bond yields, and also I'll give you an idea where what kind of stock versus bond distribution I recommend after this. Then we'll go into we'll cover the constituent changes for it's actually the second quarter. I just didn't change that from fourth quarter to second quarter. Basically, the index every quarter there are usually at least a few different companies that get replaced in the index by other companies, and we'll get into that. It's always good to know what's going on that end. So to help understand that, companies, if a company goes bankrupt, they're not going to stay in the index. They're going to get replaced by a company that's in better shape. And that actually did happen earlier this year with Pacific Gas and Electric. So this isn't like a gravity thing. What goes up comes down game. It's when it comes to stock indexes, they're designed to always go upward, and they do that by always weeding out the weak links in there and replacing them with stronger players. All right, so then after that, we'll talk about sector earnings. Basically, the overall breadth, and basically what this is doing is to figure out how broad the participation is across both the index itself and each respective industry. Because basically, the more broad the growth is, or the more broad the contraction is, the more profound it's going to be, or more solid it is. If you see everything where, I would say, if everybody's got, let's say, 60-70% stronger participation in the growth, then that's a good thing for the economy. All right, I'll get more into that a little bit later. And also, at the last slide will be about dividend stats. Basically, give an idea how many dividend increases or decreases there were across the entire index this quarter, and then how each sector was over that time. Because this is another indicator. When companies are more optimistic about their prospects of future growth, they're more likely to increase their dividend payments. Versus, if they're a little bit more pessimistic, they're going to decrease their dividend changing activities, and then if earnings are dropping, it's a little more likely they're going to decrease or even eliminate their dividends. But we'll get on to that to give you kind of an idea what's going on when we get to that particular slide. All right, so the first slide here we're going to talk about is index-wide performance results. The orange section at the bottom here is the what we got going on with this most recently reported quarter. There are 505 stock symbols, but only 500 companies. So basically, 5 companies I did not put data in here for. It's one that I just don't have. They're too new after a merger, and it involves a foreign company, I think, also, and I just don't have good earnings data, that fits with my process to put in there. A couple others delayed their reports until July, and there are a couple others that were just result of mergers that they just don't have information. And then the last one got Kraft Heinz, which they reported earnings, but they are delaying the release of their official numbers because of the criminal issue that they had happen with one of their employees or some of their employees, whatever. Now they're trying to correct that, trying to correct all those issues first, and then restate their earnings. What the more accurate figure is without the effects of the erroneous reporting by their employees before, and they're basically going to fix that first before they before they report that data. All right. Well, anyway, what is this information telling us? We have out of the 500, we've got a little bit, almost just below 5% year-over-year growth over the last year. So what this is comparison of the 688 to the 544 right here, the same quarter the previous year. You want to it's always ideal to make year-over-year quarterly comparisons like this, and not sequential comparisons like from first quarter to second quarter, second to third, and so on, because companies are cyclical in nature, and they tend to have specific quarters where they perform a certain way. So it's better to compare them how they do that same quarter because of that cyclical nature. Anyway, I had about just under 5% positive growth index-wide. I had 318 of the companies reported some form of positive growth. 12 of them reported basically flat, neutral conditions, were not really any growth, but not any contraction either. And then 170 reported negative growth. That's about 63.6% of the index reported positive growth. It's definitely lower than what we've seen over the last actually couple of years here. Last time we saw a number that low was back here in the third quarter of 2016. That's not necessarily a bad thing. It's as you see, had a slower growth then at 2.28% that particular quarter, but it's just we have a very strong standard set over the last couple of years to compare this current quarter up with. So I don't want that to be alarming. It is slowing down, but you're going to see from other slides coming up later that this is not really a major cause for concern. There are some concerns there. I'm not going to sugarcoat things, and there is always a possibility that that things could get worse and all that. But from what I'm seeing, at least from the earnings, I don't have reason to believe that's actually going to happen, and we'll get to that later. All right, moving on here, we got the quarterly earnings stats by sector. What we really care about here is what was I expecting before the quarter started, which was 1.39%, and what did they actually report, which was actually the other slide said 4.95%. This says 4.99. So it's just a slight difference in how these things are figured out, but it's virtually the same. It was definitely an easy beat over what was previously expected, which is always a good sign. So who had the strongest performance relative to expectations? That was the real estate sector, which they routinely have been doing over the last few years. I like to see that. A lot of green here, which is what we like to see. The only ones that were underperforming were the two that are both sensitive to crude oil prices, which are energy and materials. So when crude oil prices are dropping, it's not a surprise that the energy and materials sector are both struggle. And they seem to be the only ones that are struggling with the earnings right now. So, and even then, there's actually energy sector is the only one that had no, actually, information technology also saw a drop in earnings, but yeah, not quite so strong. Materials was more flat, but um, yeah. Anyway, that's this is the in 2014 and 2015, this is actually a similar situation that happened where oil prices were dropping. They kept dropping, and energy sector was single-handedly basically holding the entire index down. The I'm not saying that the growth across the rest of the index was strong at that particular time, but everybody else was positive at the time except for, you guessed it, energy and materials, and particularly energy was the one. Basically, they were canceling out all the gains from everybody else, just themselves. Uh, so this is why we like to see what's going on with the broader index, and and what each of the groups within the index, the 11 sectors, are actually have going on, so we get kind of a better feel for how healthy or unhealthy the economy really is. So right now, this actually looks pretty promising here. All right, so moving on, the index price targets versus valuation levels. Okay, these, there's always a lot of confusion on this. Basically, if you're a buy and hold investor, the yellow line is where your target is. So you see, we still have quite a bit of growth from our current price, which we had just had a recent record high last week, or not long ago, and it dropped back down slightly, but it has bounced and is on its way back up. We still have a pretty good distance to go to get back to that buy and hold target, which I currently have at the 32.45 level. The index has just hit its new record high on, recently, I was saying, at the 29.64 level. So we're still 250 points easily, or closer to 300 points below where we really could be on the index. As far, as what to expect from it over the next year, I should say. The red line here, the solid red line, is where I say that's the max reasonable short-term value of the index. So it could go higher, basically get up to the 31.40 level before it gets to the point where I think prices are in the short term getting too high, or as high as they really need to be given the current earnings situation. So, and that same point is where, for the swing traders who follow me, that's the point where I'm more apt to make a trade, a short-term move back to the G fund personally, if I'm going to at all. If it's not up in that range, I'm more likely going to buy and hold. And for most of you guys on the who are watching this, you should hopefully be in the buy and hold group and not be so concerned with what the swing traders do. So focus mostly on the yellow line if you're a buy and holder, and as long as it keeps pointing upward from where we're currently at, that's what your main concern is with. All right, the bigger the gap is upward from where the current price is to the yellow line, the more optimistic you should be. In fact, if the price here gets up here to this yellow line, very close to the yellow line, I'd be a lot more concerned that either the valuations are definitely getting a little too much, or the growth is slow, earnings growth expectation is slowed too much, or something along that line. But it's not such a good thing if you see the actual price really super close to the yellow line, and even worse if it's above the yellow line, because if it's above the yellow line, I about guarantee the stock prices are too high for the current situation, and they're likely to drop before long. And which you actually did see at the beginning of 2018, when stock prices shot up really fast. They actually did get up considerable distance above my yellow line, but as soon after, a correction came and got prices back down right into the range I expected them to be in. So this is why I like to look at this stuff. And why I think it's important for you to know what's going on with this as well. All right, so for the swing traders here, the red lines here and the green lines here is where I call a normal, rational trading range. The top end of the price range should be around in between the dashed and solid red lines, and then when sell-offs happen, they should normally drop down into this dashed and solid green line range here at the 30,000 to 3,030 level before they bounce back upward. You see, we're still down in what I call medium volatility range, even though if we look at the CBOE volatility index, or VIX, the level on the VIX is actually it's not high but not low either. It could definitely get lower before we see a legitimate peak, in my opinion. All right, anyway, I think that's it's enough dragging on with this particular slide. I want to keep this moving, so let's move on to the next one here. Forward earnings growth projections. Basically, this is to give you an idea of what the trailing, what it looks like in the rearview mirror over the last few quarters, what to expect in the quarters ahead, and that means the stock market's opening right now. That's why you're hearing that noise. Okay, previous quarter had basically the 12-month earnings total, the value of the index, at least on my end, was 2,995. The most recently finished quarter, which I'm reporting on right here, is 3,030 is what the index is valued at, and that's if we're in a zero growth environment. So if earnings growth is expected to be flat, then I would expect the index to top out at 3030. But since there's positive growth, and since share prices are based primarily on forward expectations, but they also factor in what has already happened, that's we normally should see prices up above that point. Okay, in the next 4 quarters, expect some slow growth over the next 2 quarters. Got barely over 1% expected next quarter, and then less than 2% still at the end of the year. But after that, the pace should pick back up. And as you see here, we had 5% actual growth over the last year, and it should still be about lower single digits, 4 and 3% range over the next 2 quarters. But at second, like I said, start of 2020, the pace should pick back up and start seeing double-digit growth again if all goes as expected. Now, what this does here is tells basically a rough idea how much my trailing value here, the 3030 number, should change by each of these quarters. So again, here, see basically the 3030 number should only climb to about 3060 at the end of next quarter, and should get up to about 3085-ish by the end of the year, but then should accelerate in first and second quarters of 2020. All right, so this is a positive thing when we see the further out quarters are faster positive growth than the more recent quarters, or the more close upcoming quarters, whatever you want to say. All right, next, have historical price performance versus earnings data. First yellow line is what we just finished. The index actually closed at 2941.76. That was a 3.79% actual performance for the quarter. Not so strong, but it's still plenty, to be honest with you. If you get 3.79% every quarter, that's 7.5% every semi-annual period, and about 15% growth in a year. That's nothing to complain about whatsoever. So it's just what did we see the previous quarter? We basically recouped what losses we have, pretty much all of what losses we had at the end of 2018. 12-month performance, as you see, is back up to 8.22%. It's still kind of recovering from the drop. We did have mid-teens area growth, even a high teens growth in 2017. So this is it's actually still reasonable growth here. Nothing to really complain about. And like I say, if all goes as expected, it should accelerate some more over the next couple quarters. The 24-month performance, we also see that's down. Like I said, it's been up around 30% over a 2-year period, starting with the end of 2017. It really slowed down with that drop in fourth quarter 2018, but is on its way back up. That's a good sign. Okay, quarterly earnings though, because we want to know how quarterly earnings have actually performed relative to price performance. And ultimately, what we see here is 24-month performance is still staying up around the 35% range, but actual price performance is lagging. So that's another indication that price performance might not be still as strong as it really could be. Yeah, there are some indications that the prices might be overvalued to some extent, but what I see here from the earnings data, it's more reason to think that there's still more gains to be had. Okay, quarterly performance, still have another number here, but still up in above 4.5%. And 12-month performance is up over 18% as far as actual earnings growth has been concerned. So these are all positive notes here, you guys. This is not something you would normally see when the economy is about to go into recession. Okay, so wouldn't be so overly concerned about what's going to happen that you start scrambling to the G fund or something. There's not a real reason to do that, and if you do go to the G fund more often than not, you're better off going only partially to the G fund and not all of it. All right, so moving on here, let's look at the bond yields. Bond yields get talked about a lot by the media. They always worry that inverted yield curve, like you actually see here, is foretelling of a future recession. That's not always the case, and there's a lot more to this than what they report, of course, because a horse is a horse, of course. But anyway, the logic that people use here, and there is some truth to it. I'm not saying that they're wrong, but there's a lot more involved than what they're willing to accept. Okay, now banks basically borrow money at the short end to leverage their profits so they can lend the money out on this end. But so if they're basically have to pay as much to get the money to lend out as they're going to get back from their loans that they're issuing out to banks, consumers, whoever it might be, they're going to be less willing to give out to borrow the money so they can give it out. If it's not going to do them any good, then what's the point? So they want to get some kind of profit out of it if they're going to do it at all. So, and you can do the same thing with real estate or other industries too. Something I had learned, because I'm not really an expert on the real estate industry, but I'll just give you something similar because some of you guys might actually understand real estate. If you had $200,000, or let's just say $300,000, and you wanted to rent the properties out, or rent your property out, whatever, and basically try to make an extra, basically grow your wealth from it. Would it be better to take the $300,000 you already have in hand and buy one house with it and rent it out to one renter, or would it be better to put $150,000 down into two separate homes, get a loan for $150,000 for each of those two homes, and have renters rent from both of those properties? Which one do you think is actually going to get you a better profit? And even more so, let's just say if you have that 300 and you put 100,000 down into each of three different homes, and so it's the same process here. That's where they're getting at. And so you actually can leverage your profits by borrowing money. And this real estate analogy is exactly the same situation there. It's more if it's cost effective for you to borrow in order to lend out, or to get that revenue stream in, and it's worthwhile move. Now the problem here is that there's a lot more to this. What impacts bond yields, and what impacts banks' actual ability to borrow and be cost effective with their borrowing and move on and lend it out to others. Okay, so U.S. Treasury notes are not the only place they look at for, and a lot of other bonds are based on U.S. Treasuries. Maybe they could be getting their money from foreign sources, like from Germany or somewhere, or some other place where they can borrow the money from from some other country, and where they expect the strength of the U.S. dollar to increase. And if the dollar increases in strength relative to some other country, then they can they basically, it's cheaper for them to pay off that particular loan by doing that. And so that's something else that needs to be considered, as foreign sources and other non-government bond sources and stuff. So don't get too fixated on what bond yields are doing, because like I say, it usually takes at least a good anywhere between 9 months and 2 years before a recession normally begins, when bond yields invert. However, there's also something else to consider here. What are bond yields normally at when the stock markets really do top out? It's quite normal for them to get up in the 5-6% range, and then start working their way back down a little bit before the stock markets actually top out. What we have here is bond yields they're not even above 3%. They're barely even at 2.5% on the 30-year note. Yeah, and most all of them are still barely even not even half what they normally are at the start of previous recessions. Also, what impacts the short-term yields and what impacts the long-term yields? Okay, so the Federal Open Market Committee, or as we call it, the Fed, they basically the group that decides on what the bond rate policy is. They have a greater impact on the short-term yields. So you see the 1 month and 2 month yields are actually right in the neighborhood of where they have their current target set at, which is, I think, is 2.25 to 2.5%, somewhere around that ballpark, if I remember right. The medium and long-term bonds are more impacted by investors and how pessimistic or optimistic they are about the economy. So when investors get a little bit more pessimistic, they tend to drive down the medium and longer term bonds, and create this inversion that you see here, where the short term bonds are higher yielding than the longer term bonds. In a normal bull market situation, a healthy economy, you like to see it sloping upward like that. And we did see that, I think, a couple of years ago, or within the last year or so. I'd have to go back, but that's what a very healthy economy would look like. What we have here is definitely not healthy, but it's like I say, there's too much involved there. We are not banking experts. We don't know we don't do a lot of analysis on where we can borrow money in order to make it cost effective to lend the money. So let the banking experts worry about that part, and we'll just worry about when the earnings give us clues about when to legitimately expect some problems. Actually, earnings growth, and also unemployment rates, because the unemployment rate, if it goes up a small amount, not such a problem. But if it starts to go up and then starts to snowball into higher and higher unemployment, it's definitely gonna show up in an increasingly larger amount of corporate earnings, especially on the discretionary spending side. So that's why we look at earnings growth. All right, so bond yield curve, again, it's don't read too much into it. It's it's a lot more involved in that, and this actually could be a self-fulfilling prophecy if investors get too pessimistic and push these rates down, because it actually could trigger the banks into being more tight with their money. Versus where if you just leave the darn bond market alone and leave the bond yields where they should naturally be, it puts less pressure on the banks. All right, so that's basically the reality of how this works. It's really investor driven. All right, so bond yield curve. This is what it looked like at the end of last quarter. I just wanted to give you a comparison of how they look. It's a little bit more pronounced here. As you see, the 30-year note was up in the 2.75-ish range, actually 2.81, as you see here. It was still inverted a little bit here in the 2-year to maybe a 10-year-ish range, but not so pronounced. If you go back to this, it definitely starts to slope down as soon as you get to the 2 month, and starts working its way back up at the 5-year. But it's only the 20 and 30-year notes that are yielding higher right now than the short-term yields is what this looks like. All right, so bond versus stock earnings, basically using what I call the beer ratio, bond to earnings, bond to equity earnings ratio. What am I expecting from the S&P 500, and what is the current yield on the 10-year Treasury note? That gives an idea on how much your money should ideally be focused on stocks and how much should be on bonds. As you see here, got 7.07% is what I'm expecting from the S&P 500 over the next year. 10-year Treasury note has dropped all the way to 2% now, which and the more bond yields drop, the more attractive stocks become, and the stronger stock earnings get, the also the stronger stock, the more attractive stocks become. Vice versa, if stock earnings drop or expectations drop and the Treasury yields rise, then it starts to become and stocks become less attractive and bonds become more attractive. Particularly when it comes to dealing with bonds versus dividend-paying stocks, that's always a good comparison to make here. If bond yields are only around 2%, but dividend yields are typically going to be, let's say, 2.5% to 3%, then investors are more apt to keep their money in stocks and focus on the dividend payers, and because they can get a better return without even having to worry about what the share price does. They're going to get that yield anyway. All right, so based on what we have here, the current recommendation is anything in the 75 to 80% stocks range and 20 to 25% in bonds. The raw number I actually came up with was 77, just about 78%. As far as if you wanted to look from a 1%, actually even less than 1% increment, it was above 77 but below 78. But yeah, we're above that 77.5 point, so that's where I'm kind of saying it's on the cusp of 75 to 80% stocks that you should be focusing on. Now, I did the last time I did update my announcement post in the group, I did increase it from 70 to 75% stocks, and as you see here, you can actually even get up to 80% and be okay. All right, so constituent changes in the S&P 500 this quarter. That's just this quarter alone. There were 3 constituent changes, and here they are. This is actually a pretty slow quarter as far as that's concerned. A typical year, I normally see about 24 or so constituents get replaced in the index over the course of an entire calendar year. So only 3 of them in a quarter. That comes up to only about 12 in a year average, and that's actually half the pace we normally see. All right, so the first one that happened was in April. Had Dow Incorporated. They were replaced by, they entered the index. It really was a spinoff, though. They replaced Bright House Financial. Bright House Financial was bumped out of the index because of market cap, and basically Dow Incorporated was part of Dow DuPont, which was already in the index. They got spun off into their own separate company. But both pieces that remained from that spinoff are large enough to stay in the index. That's why that happened. The second one that happened was earlier in June. This is Corteva Incorporated, CTVA. They replaced Fluor. DuPont. This was also related to that DuPont spinoff. That was also a spinoff from Dow DuPont directly. Dow DuPont will change its name to DuPont de Nemours Incorporated and change its ticker to DD. So that has already happened. So basically, CTVA is actually DD. And Fluor got bumped as well, also because of its market cap rate. And lastly, less than a week after that, Bemis Company Incorporated, BMS, got added to the index, and they replaced Mattel, MAT. Amcor Limited merged with Bemis. And after the merger, the company will be named Amcor PLC and will use the ticker AMCR. So basically, BMS was the company that merged, and the new version is going to be AMCR. And Mattel got bumped also because of market cap rate. So I say this has been a slow quarter, not just with earnings, but also with constituent replacement activity. As you see here, this is all M&A kind of actions that caused all this as well. Merger and acquisition is what M&A is, or also spinoff or divestiture. All right, looking at sector earnings health now. What we're looking at the rear view look first, and then the next slide we'll talk about the forward look over the next quarter. All right, so the more blue you see in this particular slide in the chart, the more positive that particular sector looks. So as you see, the energy sector down at 43%. It's the only sector that had more earnings losses than there were gains in this most recently reported quarter. Everybody else was at least 50%. Materials was barely above water. As you see, only one more in the red would have put them under the 50% as well. Real estate, one more down, would have had them right at the 50% level. But otherwise, everybody else was positive. Yeah, at least 60% ideally I'd like to see on everybody. And on some of these other sectors like consumer discretionary and financials, really like to see stuff up 80, even 90%, and know that they're in really good shape. Consumer discretionary is down at 60%. It is a little bit of a concern to me because that's the area that gets hit the hardest when the economy starts to falter. And so when people don't have money to spend, they stop going out to buy to eat at restaurants. They stop going out on vacations, stop going on cruises and things like that. And then they're more apt to spend their money on necessary food items than actually cook at home. So consumer staples, that's where the necessary food items are at. And and the restaurants are more in the consumer discretionary sector. So consumer discretionary is down below consumer services or consumer staples. I mean, that's, like I say, that is a concern. It's not enough of a concern to where we need to be scrambling to the G fund, though. All right, so it just means be aware of this going on, and maybe, if you're not comfortable with having a 100% stock distribution, then maybe scale back a little bit, but not all the way to the G fund 100%. Like I say, follow that beer ratio distribution that I talked about, 75 to 80% stocks. I think you'll be fine. And that does change regularly. Anytime I do see the earnings versus bond yield picture change, I don't wait for the end of the quarter to come to change that number. If I see the number change enough where it changes my calculations, then I will make an adjustment in the middle of a quarter at any given point in time. So just watch for those announcement post changes if you're in the group watching this. All right, next one. Okay, well, this slide here shows this is a next quarter expectation, what each sector, basically what I'm expecting from each quarter this next quarter. Again, we do see not the strongest growth in the world, but it's still mostly positive. Yeah. So that's a good thing. Real estate is the only sector that I'm expecting to see more negative than positive from. But even that, I wouldn't make too much of a bet on that happening, because real estate, I've expected to consistently see declines over the last couple of years, and every single quarter it's always strongly outperformed what the analysts' expectations were that play a role in my data here. Basically, it's overall still looks good. Still a little bit of weakness here in the energy and materials areas, but a good thing here is consumer staples is expected to be on the weaker end of the group. That's a defensive sector, so we'd like to see everything outperforming consumer staples, normally speaking. Actually, consumer staples and utilities particularly used to also be telecommunications, but when they did the industrial sector classification change, to where they made it where the communications, they renamed telecommunication services to communication services, and they have more cyclically strong companies in there like Amazon and the likes like that. So that's no longer what I would call a defensive sector. But at very minimum, I would say consumer staples and utilities are the two sectors you really want to watch what's going on with them. If they're at or near the bottom, then it's a good thing. But if they're up near the top, then there's a problem. Normally speak in a normal situation here. All right, next. All right, next slide here. We got sector dividend changes. This should be the last slide here, actually. There may or may not be one more. Basically, again, I want to get an idea on what's going on with dividend changing activities of the companies in the index that do actually have dividends. That they actually do pay them. Not every company in the index pays a dividend, but a pretty good number of them do. As you see here, okay, the colored column here tells you how many companies total are in that sector. Basically, it should be about 505. I didn't run a total on it, but if the more green it is, the more companies that are in that sector. And then, of course, consumer services, that's the smallest sector at 22 companies. Now, this column here is how many companies in that particular sector do pay a dividend. So as you see, like consumer services, only 13 of the 22 pay a dividend. There's some others like energy, where all 29 of them do. Speaking of here, with the constituent changes, 2014, I was talking earlier about how when oil prices were dropping and energy sector was single-handedly holding down the rest of the index. And at that point in time, there actually were 40 energy sector companies in the index, and it's actually steadily dropped. I think it was down to like 33, 32 or something like that. Even earlier this year, or within the last 6 months, but it's dropped. So that's one of the examples of where Standard & Poor's they're going to try to make this index as resilient as possible and keep it moving upward as much as they can. All right. There was only one dividend reduction that happened at all in the entire index, and that was in the materials sector. I forget which company it was, but because I'm more interested in the overall numbers. What's the total changes? Now, this total here is basically the difference between how many positive changes were made versus how many negative changes were made across the entire index that particular quarter. So as you saw in fourth quarter, there were 159, or actually the score was 159. Basically, take all the increases and subtract the decreases, and it came out to 159. And you can have a breakdown by the score breakdown by sector here as well. Basically, it's been slowing down. It got down to 110 in first quarter, and it's down to 72 this quarter. So it is dropping, and that's exactly what I expected to happen. It's still an ongoing experiment of mine, I guess I would call it, but so far it's holding exactly true to what I expect to take place, and that's when earnings growth is starting to flatline more, should see much less dividend changing activity, or and then when earnings growth is stronger, should see a more strongly positive number on this. So it's still positive here. It's just not even half as strong as it was 2 quarters ago, though. So there is that to consider. But what does it do from here is what we're more concerned with. Is it going to keep continuing downward trend like it is right now, or is it going to flatten out some? Is it going to go back up? We don't know that. We'll look at the next quarter, see how it looks again 3 months from now. But but it's still overall positive number here. It's just sloping downward, unfortunately. Hope you got a lot of good information here. And if you're not understanding really how well this translates to your TSP account, please ask. This is that's the entire reason why I post this, is to know what's going on for my own account, and also to share with you what I see going on, and what I pay attention to and why I pay attention to it. If I pay attention to it, it's probably a good idea that you should you might want to pay attention to it as well. All right, that's it. Thanks for watching.